So,
Sorry.
so, sorry about that. So yeah, I'm Tim White. I've been in accounting for about 12 years now. I should have updated that. And a tax preparer for about 14 years now. I mostly work with small businesses, particularly artists. So I've been doing that, like I said, about 14 years now. So yeah, it's just a little bit about me. So this is how I want to structure this seminar. The first thing I'm going to go about is the anatomy of tax return. So the tax return generally is like a body, and then it's got like arms and legs basically. So I'm going to explain how we put that together to make one big tax return. Um, and then I'm going to go into specifically the Schedule C, which is the business portion of the tax return. I'll go into some stuff about 1099s because that's something generally artists generally either receive or have to send out. So I think that's a good topic to explore. Grants, something, money coming in and other income for the artists. I want to get into a little bit about that. Expenses, stuff that's on everyone's mind, any business owner's mind, especially artists. What's deductible, what's not. And then I'm gonna go into changes 2020 for 2022. There's been just moderate amount of changes. There were a lot of changes last year due to COVID and other things happening in the world. So it's not as many, but the ones that we do have for 2022 this time are pretty big. So I definitely want to go over that, and then finally I'll take questions for your particular tax situation if you have any questions about anything that I might not have gone over, or if you want to clarify something that I did go over. So yeah, so I talked about the anatomy and the tax return. The When it comes, people look at the taxes and say, "Oh, it's so complicated," but all it really is just a main form, which is the 1040, and it's just supported by forms and schedules, basically. So while somebody with nothing happening could use just the 1040 to file their taxes, people who have a lot happening, they need to fill out schedules and forms, and those totals will feed into the main form. So if you took all the schedules and forms away, all you have was just a bunch of numbers being unsupported by anything. So that's why I said in the beginning, where it's just like the 1040 is like the torso, and we're going to be putting like the head and then the arms and legs on it, and then we'll have a full-fledged tax return. But I have here that the basic formula is your income minus deductions minus the standard deduction, and that will be what's called your that's what the amount of taxes you'll be, that's the bottom line number that the IRS will assess you on, and then give you how much taxes you owe on that number. Then we're going to go ahead and add other taxes, and I have like self-employment tax, and I'll get into that a little bit later, because on your tax return, we're not just going after income tax. You have other taxes that you have to pay on this return as well, minus credits, like stuff like child tax credit, like those sort of credits. So like the things that the government gives you for to go against that tax bill, basically. And then what you have left is what the final amount owed, and who's owed depends on that number. If that number is negative, then you're the one that's owed, and then you'll get a refund at the end of the year. And if that number is positive, that's your shortfall, and that's how much you still owe the government, and then you have to pay that. So nobody likes to see that, but that's generally what the formula is going. So yeah, we're using the tax return generally to just figure that bottom number, and then you're either going to get a check, or unfortunately you'll have to send a check. So the first part of this equation is the income portion. So the income portion, I just listed a few here that are just like common common income sources. So the first is wages from W-2. That's simple. Anytime you get a work for a company at the end of the year, they'll send you a W-2 basically, and they'll have information on there how much you got paid during that time, and you'll report that on line 2 of the 1040. And then I have business income, and that gets reported on Schedule C. We'll get more into that, but I just put it on here just show as an example of what type of income that you'll be putting in the first section of the tax return. Investments, if you have any like dividends, if you sold stock for profit, so like capital gain, things along those lines. And then most recently, like gains on crypto, stuff like that, you'll want to also report it on the first section of the 1040. Then I have rental properties. Sometimes people will have like rent and then they'll make money on that. So like basically if their income outweighs their expense, just like any other business income, but you'll just report that on a separate schedule. And then I also have retirement income. So for like older folk who get like Social Security or like get a pension, then you'll also have to report that in the income section as well. So this list is not definitive, but these are some of the most common ones. So that's the first part of the 1040 is the income. So you have your income as first as your base. And then I have minus deductions, mostly reported on Schedule A here. So your deductions are not credits, but they reduce the amount of income that the IRS will take into account when it assess you for that final number. So I just like income, I have just some of the most common ones on here. I have educator expenses. Sometimes teachers will come out their own pocket for expenses and other expenses that they're able to write off. So I have I put that on here. HSA deductions, like when you have a health savings account and you contribute to that, there's a portion of that you can write up that you can deduct from your income as well. I have the deductible part of self-employment taxes. I keep pushing self-employment down, and I will get to that when we get into the Schedule C portion, because that generally deals with business income. But self-employment taxes generally have two parts on its form. There is a deduction part that will take half of it off of your income, and then they assess the full amount later on the other taxes portion. And like I said, I'll get more into depth about that a little later on. Then I have the IRA deduction. The IRS allows you to give up to $5,500 to your own IRA, and you can use that as a deduction every year. So that's pretty nice. If you have a lot of cash around, you want to lower your tax bill. So it's like kind of paying yourself instead of paying the IRS. I've had a couple clients actually use that to get out of a tax bill. So it's like you have to pay the money, so you might as well pay yourself instead of paying the IRS. So that's pretty neat to have. Student loan interest, unfortunately, that's a lot of us have student loans, and you can write off the interest. So that's pretty nice. Tuition and fee deduction. If you're going to school or had go to school, if you are actively in school, you can write off a portion of your tuition. You can either take it as a deduction, or later on in the seminar, I'll go over that you can also take it as a credit. So as far as like, depending on like your situation, you'll want to take advantage of either using it as a deduction or a credit. And when I get into credits, that sentence will make more sense, because again, like we've already taken our income, and now we are taking money off of their income with deductions. And then finally, I've got the qualified business income deduction. I have it in green because it's a function of the Schedule C, which is the business portion of the income, I'm about to say income statement of the 1040. The qualified business income deduction basically gives you 20% back if you made anything. So if your business is profitable for the year, that's just the government giving you 20% of it as a deduction. So that's pretty nice. That means that at most you'll pay taxes on 80% of your profit as opposed to 100. So that's pretty nice. So we have income minus deductions minus the standard or itemized deduction. So we'll take one of these numbers. Most people will generally take the standard deduction, and that's why I have the standard deduction is most common, because what used to happen was it used to not be as high. It used to be lower, and we would have something called exemptions with it that could make it get higher than what it is now. So take a person who has take a single person who has 3 kids. They would have, so if we take half the head of the household, that would be around round down to 9,500 basically. So 9,500, but you would get 4,000 per kid. So if you were getting 4,000 per kid, you would be getting more than what it is now, which is 18,800, which is basically they doubled it for everybody. So it kind of hurt a lot of people a lot of big families, because they were not getting the big itemized deduction. I mean, the big standard deduction that they normally were getting. But that's just a little history. They took that off with the Trump tax cuts. So that's one of the things that that kind of did. And it wasn't very popular. But that's why, because it generally took money out of big families' pockets. But now what we have is a standard deduction. So this works for some people though. It doubled the standard deduction. So if you're single, you're just going to take 12,550 off of that amount that we have. So if we have income minus deductions minus the standard deduction of 12,550 for a single person, that could bring your stuff down to 0 by itself. And then married filing jointly is double that amount. So, but then you have 2 people filing at the same time. So it probably won't bring it down to 0, but it does take a big chunk out of it. And then, like I said, head of households 18,800. So I have down here, you'll use the standard itemized deduction if the sum of the following items are greater than the standard deduction. Use the Schedule A. So basically, you'll want to use the higher of either your standard deduction or the sum of your health expenses, your state and local taxes. So your state and local taxes is generally when you get a paycheck, you'll pay federal taxes out of it, but you'll also pay something to, I live in Pennsylvania, so I'll pay 3.07% to Pennsylvania. And then I work in Philadelphia, I work at the Mann Center. So I would be paying city taxes about 3.5%, I want to say. So that amount that will go towards, I will get all that money back if I was itemizing. But again, I won't itemize unless the sum of all these is higher than the standard deduction. Now, I'm married, so married filing jointly is 25,000. So I would be having to, well, I'll get to that in the end, but basically all these things have to be over 25,100 for me to take advantage of it. And as you can see, state and local taxes are capped at 10,000. So even if I had a super high paying job and I was paying tens of thousands of dollars in local taxes, I wouldn't be able to go over 10,000. So that was another side effect of the Trump tax cuts. So you can see what's happening here. But real estate expenses for your main home. So if you are an investor and you have a bunch of investment properties, the interest tax and premiums on those do not go against that. Only the main house that you live in, you can deduct your home interest, your real estate taxes, and if you pay under 20%, then you'll pay a mortgage insurance premium, and you can write that off as well. And then donations, so anything that you donate. So if you are a high roller, or if you tithe in church, and you could generally if you're giving 10% at church, then that could add up pretty quickly. So but you only get to take the advantage of this if you're itemizing. So again, it's really because I get that question a lot. It's just Tim, I gave $8,000 to the church this year. I'm gonna be able to write that off, right? And I'm gonna say, if it beats the standard deduction, and that generally is it with them, it'd be people who don't own their home, who don't have a lot of health expenses. So when it comes down to it, they don't reach that threshold. So it's like they don't get any benefit from that tax money. So I mean, from that deduction, at least beyond like just give that the donation just by itself. So uh, and then I have unreimbursed job expenses on here as well, and that is past what you are reimbursed at your job. So if your job gives you money back, and if you go out and like spend the money for like uniforms or something, and it costs $200, but they gave you 100 towards it, then the other 100 is what you would be able to write off, not 200, obviously. So that's just a basically what's happening with with the standard versus itemized deduction. Like I said, it's most common that most people will take the standard deduction, but some people will itemize. I say I itemize out of all the returns I did last year, I might have itemized maybe two. So out of a whole season's worth of tax returns. So it gives you an idea of how uncommon it is for people to itemize nowadays. So you have the income minus deductions minus the standard deduction, and that's going to be the amount that you're assessed on your income tax. So I have here the amount of income tax is based on that adjusted number after deductions. And then sometimes you'll find forms that will ask you for your adjusted gross income. That is just income minus deduction. That isn't minus the standard deduction. So if something is asking you what the AGI is, then it's just your income minus deduction, not minus the standard deduction as well. But that's just a little side note. The income tax assessed number is your income minus your deductions minus either your standard or itemized deduction. So what you'll do is once you have that number in the IRS packet, they have a neat tax table because in the United States, we have what's called the progressive tax system. So basically, if you earn $50,000, then the first portion of that, let's say the first $12,000 of that is taxed at one rate, and then the next $15,000 is taxed at the next rate. So if you had to do that math manually, they would be getting a lot of mistakes. So they have a big booklet in there that you just basically take this number and then you look at what column your filing status is, and then you just find the intersection, and that's their number. Basically, they took all the guesswork out of it, but that's what's happening in the background of that document is the progressive tax system at work, basically. So yeah, so that number that is at that intersection is what you'll put on the tax return, and that is the amount of tax that you owe at this point. So like, bottom line, after everything, this is the amount of money that you owe the IRS. So then once we have that number, then we'll start applying credits. And the first credit that we'll apply is our non-refundable credits. These are credits that bring that income tax assessed number down and to the previous step, and that it can go down to just zero. It cannot go under zero. When we get into refundable credits later on, that number can bring it to a negative, and as we said at the beginning, a negative number will mean that the IRS owes you money, and then you'll get a refund. So I just have a small list of non-refundable credits here. And again, all these lists are not definitive lists. I just use some of the most common stuff. So the first is the child tax credit, and that's a big deal this year because the Biden administration has been sending out checks to people with children as an advance on the child tax credit. So if you're getting a check in the mail each month, it's because they're taking this credit, and instead of applying it to this number here, they're fronting it to you, basically. So there's a non-refundable portion of the top child tax credit and a refundable portion. So I'll get into a refundable portion later. But the non-refundable, so let's, like, for instance, I have one child. So one child under 6 will yield you $3,600 per child, and that's up from $2,000 from last year. So let's say my income tax assessed number was $3,500. And then I have one child, so and there that credit is 3,600. So that will basically wipe that whole 3,500 out, and I'll be left with 100 that may be refundable later, depending on income level. So I just said that to illustrate how it can't bring your total down underneath zero. These non-refundable credits can only bring the income tax assessed number down to zero. So child tax credit is one. Child and dependent care expenses are another. That's like daycare. That's for like like camps, like sleepaway camps and stuff like that. Uh, Bringing in a person into your home to watch your child, stuff like that. You can get a credit for. Education credits, like I said earlier, you either want to take the deduction earlier, which is also called above the line. So now we're below the line, basically. So however whatever's going to be more beneficial to your tax situation, you'll either take the deduction above the line or the credits below the line as far as education credits are concerned. And then I have residential energy credits. Like there's credits for like getting solar, basically making some energy efficient repairs to your home is another one. It's not very it's very narrow as far as these credits are concerned, but they are out there and they do help, especially if like you're doing like work around your home and stuff like that. So we have income minus deductions minus the standard deduction equals your income tax assessed number. Now we've taken non-refundable credits off of that, which could bring it down to zero. And now we're going to add numbers to it. Unfortunately, we want to keep the minuses going, but now we have to add something. You add your other taxes to it. So, like I said, we're not just figuring out income tax. There's other taxes, and mainly the main one I got it highlighted in big here is self-employment taxes. That's what's going to be most germane to artists. So, like if you are making money, you make a profit on you made a profit in the year, you'll have to pay self-employment taxes. That's different from income tax. That's why it's on top of, so like that's why that number can come down to zero. But then if you got big self-employment taxes, then you're back to square one basically as far as owing the IRS. I also have Obamacare excess repayment because I see that a lot too. So what happened with Obamacare is when people get a subsidy for that, what they're doing is like the child tax credit is doing now. They're saying, well, we're looking at your income and we think that you're going to get a refund. So we're going to front you part of your refund to pay for health insurance. But if your income raises significantly over their estimate, then you don't get as much of a refund in their eyes. So you have to pay some of that back, basically. That's on top. So again, that is separate from your income tax. That's more of a reconciliation for something outside the whole tax thing. They're just using the tax return to like square up on that in that regard. But basically, because that's not really a tax. Well, it is a tax. It's called the premium tax, but that's not really a tax. That's something that they really made up. I think an easier way to think about it is just that like it is a squaring up of Obamacare and how much they fronted you. So if they fronted you too much, then you have to pay some of that back. And if they fronted you too little, as you'll see later on when we get to refundable credits, you'll get some of that money back. And then I also have repayment of the first time home buyer's credit. Back in 2008, if the government fronted people money, they allow people to take one big credit in 2008 to buy homes. So basically to offset the cost of buying their first home. So they were allowed to take a huge credit on their tax returns and it was all refundable. The catch is they had to pay it back over the next 10 years to do that. So that is another tax that's going on. And now I'm thinking about it, 10 years from 2008 should have already elapsed that. But it might be a situation where you might have skipped years or gotten permission to skip years, but that's one of the more common ones I see too, because I have a few clients that have to pay that every year, and I have them marked down. But on Schedule 2, where all these other taxes are filed, you'll also put that on there as well. And again, it's not a definitive list. It's just these are most of the ones that I've come across. But like I said, self-employment taxes are generally the big one when it comes to this for any business, especially artists. So now we're taking things off again. So now we're doing, so just to recap, and I know this is getting sound like a broken record, but I just want to really make sure it's in there. But your income minus your deductions minus your standard or itemized deduction equals your income tax assessed number minus your non-refundable credits plus your other taxes. And now we're minus payments. So payments that you already made during the year to that income tax assessed number is where we apply that. And generally what that means for most people with like a 9-to-5, like W-2 job, is the federal tax withheld. So when you get your paycheck, they've already withheld federal taxes from it. So how much you did in a year is what's going to be reported on this payment section. Now, I also have 1099 here. You generally don't find people withholding taxes on the 1099. You can, there's nothing stopping a person who issues you a 1099 to withhold taxes on your behalf, but it's very, very rare. I've never seen it done, period. But you can, it is possible to do so. Where most businesses will, where this is germane to most businesses is the income estimated taxes already paid. Generally, what you're supposed to do when you are making profit, whether it be an artist or a baker or anything, is you're supposed to make quarterly estimated taxes on that money, generally around 10 to 15%, and you send that in. If you've done that over the year, then what happens is the IRS will send you like a transcript at the end of the year that letting you know that this is how much you paid in estimated taxes, and that's the amount that you all put in payments here. That's one thing I stress to my clients all the time is pay estimated taxes, because, or if you're not paying estimated taxes, put enough away to pay taxes and pay a penalty, because if you're not paying estimated taxes and you owe at the end of the year, the IRS likes to put a little penalty on there for not paying estimated taxes. It's usually not that much. It's usually, I've seen someone owe upwards to like $6,000 and the penalty came up to about $100. So if that's something that you can stomach, instead of, I mean, I would always suggest just paying the estimated taxes. That way, you don't want to give them anything, like you don't want to give them anything extra, even if it is just $100. I mean, it's just good business not to do that. So, but if you don't do that, then that's what you're looking at. You're looking at having to pay it all at once and paying a penalty on top of it. So income minus deductions minus the standard deduction equals income tax assessed minus your non-refundable credits plus other taxes minus your payments minus refundable credits. And that's the end of the equation. So your refundable credits are credits that can bring this number down below zero. So this is where people like to run up their refunds. Now, what I didn't put on here, that's a big one, is EIC, earned income tax. Earned income credits. That's one for generally like if your earned income is under a certain threshold, and there's a lot of factors that go into that. How many people are in your family, so how many dependents you have is a big one when it comes to that. And then because all refundable as well. So, but I generally don't like to put that on here because that is something that's not really business focused, but it is out there. That is one of the biggest refundable credits, but it doesn't really affect everyone. So I didn't want to go by without at least mentioning that that's out there. But I have the additional child tax credit as the top one, because that's one that people generally get tripped up on. So if you took my example from when we talked about non-refundable credits, so let's say I owe $3,500 that was my income tax assessed number. And then I have one kid. So that gives me a credit of $3,600. So that totally wipes out the 35 and leaves me with 100. Then on the same form, they will reassess my income level and they will determine if that $100 can go into my pocket generally. So if I was like making bank, like if I was making millions of dollars and I use the child tax credit to bring my number down to zero, and then they say, well, okay, well, you made $500,000, that $100 is not refundable. So that's why they separate that. The first stuff, the first non-refundable portion, anybody could take that. But then the refundable stuff, the IRS gets a little bit, scrutinizes your income a little bit more as far as the refundable portion. So I have the additional child tax credit, because that's what it's called, additional child tax credit, if you don't use it all in the beginning. I have the American Opportunity Credit, so that's the education credit. So like child tax credit, there's a portion where it's like, regardless on whatever you have, this is non-refundable. It may bring your income tax assessed number down to zero. And then we'll look at your income again down here. And if it's low enough, or because, you know, all these forms, they have their own like calculations in them. So if the calculation is deemed that you can get the remainder of the credit, then you're allowed to get it basically. And then I have Obamacare credit, because like I said, I explained how you may be assessed the excess of that as an additional tax. It works the other way around too. So if you were making a certain amount of money and then that income dropped, then once you do that calculation is too low, you pay too much then, and then they give you that money back. So all of that equals, and I'll go over it one more time because I know you love hearing it. If your income minus your deductions minus your standard or itemized deduction, which equals your income tax assessed, minus your non-refundable credits, plus your other taxes, minus your payments, minus your refundable credits, all of that equals, and if that final number is negative, you pay too much, and the IRS is required to pay you back the difference, unfortunately, interest-free. So they get to hold your money, and you don't get any return on it, unfortunately. If the final number is positive, however, you didn't pay enough, and you have till April 18th this year, usually at the 15th, because it falls on a weekend, then it's the 18th, to pay the difference, and interest will start at April 18th. So I get a lot of questions to say, if I ask for an extension, will I pay interest on it? And the answer is yes. Will you pay a penalty on it? No. But if you don't get an extension, then at April 18th and you owe money, then penalties start then. If you get an extension, you don't have to pay the penalty, but the interest still goes. Some people don't know that. Okay, so that's the anatomy of the tax return. Now I want to shift to just focusing on the business part of that, the Schedule C. So your Schedule C is kind of just like any, I don't know if you've ever seen like an income statement, or also called a P&L statement, profit and loss statement, but it generally is formatted the same way, which you'll give a little bit of income information about your business up top, like when it was started, the NAICS code, which I'll get into a little later. Just basic info about the address and stuff like that. And then they're going to ask for your income, and then they're going to take your income and they're going to take off your expenses of it. And what's left, if that's positive business income. And that will be reported on the first section of the 1040. And if it's a negative, that also will be reported on that same time, but it's a negative. So that will go against any other income. So there's a possibility that you can have such a loss in your business that it wipes out any other income that you have on that first income section. And then, so when you're applying your standard in an itemized deduction, there's nothing to deduct from because you're coming into it as zero because you have a huge loss. That's generally what people try to do when it comes to filing their Schedule C. They'll try to pad on the expenses so they can minimize the amount that they pay in self-employment taxes and maybe income taxes. So, but that is a double-edged sword, because I can tell you that I just recently bought a house, and they looked at my income, and I was able to use it as part of the bank determination. So, and I wasn't able, you wouldn't be able to do that if you were consistently getting negatives. Now, that's not like a big deal to artists because they just want to report their income, or some artists because like some artists are like true, like in true industry, like they're trying to like grow their business, like so showing a loss on your tax return is good because you don't have to pay much in income tax, but it could hurt you in the long run because you may want somebody to look at how your business is growing and then use that to get cool stuff like determination on a mortgage. Like that sort of stuff can make or break you. So just want to just put that out there, just anecdotally about just simply trying to minimize your tax expense. If you got expenses, good. I mean, you never like do that to like just pad your numbers, but it's just something to keep in mind as far as like what's our goal here as far as reporting this stuff. Is it to accurately report, or is it trying to tell the story that we want to tell, basically? So I just wanted to focus on the 1099 and 1099, the 1099 miss and 1099 NEC. So I have the 1099 as a form that you will receive for money you paid to an organization or were paid from an organization, a person or organization, respectfully. So I'm sure everyone here has gotten a 1099 at this point. I'm sure of it. You either got a 1099 miss in most years up to last year, or a 1099 NEC last year and forward. It used to be that the 1099 miss was a catch-all for any sort of like miscellaneous income. That's 1099 miss. But it was overwhelmingly used to report like independent contractor income. So they finally have taken that part out of it and just made it its own form, basically. So that's what the 1099 NEC. However, they look identical. So like you can still use the 1099 miss if you really can, even though the new ones don't have a portion for that. But if you're filing it online, they've updated everything for you. So if you're doing everything current, you're not going to get tripped up on this, but just as a little bit of history. So you don't have to send out a 1099 if you were paid, if you paid a person or were paid under $600 in a year. So I work with, like, my wife owns Theater X. So like Theater X, sometimes they'll have players coming into their performances, and she might pay like maybe 40, 50 people $500, and that's all they paid them that year. That means none of those people are going to get a 1099 from it. Anytime any person hits over $600 for the year, then they have to get a 1099. And that works obviously the other way too. If you're paying somebody, once a person or organization hits that $600 threshold, then you have to give them a 1099. 1099s are filed in triplicate, one going to the IRS, one going to the state, and then one going to the recipient. So when you're sending it out, you're telling the IRS that the person made this X amount of money, that you're telling the state the same thing, and you're telling the recipient that you told the IRS that. So generally, people get tripped up on that because they think, well, just because I got this 1099, that doesn't mean that the IRS knows. They absolutely know. If you got it, the IRS got it. And that generally is the case for a lot of transactions that people have misconceptions about. The IRS generally knows a lot of stuff that you don't think they know. They have access to bank records. So like in the event of an audit, that's exactly what they'll do. They'll go into your bank and say, okay, what's this money? What's this money? What like money's coming in and where's it coming from, and you have to account for all of it in the audit. So don't be fooled that when you get a 1099, just assume that the IRS already knows about it, that you can't fool them. I had a client one time that she changed jobs in the middle of the year, so, and she was making good money, so like, but like she was at her old job for only, she's, oh, I was only on the old job for like a month. And that old job gave her a W-2 for like $10,000, and she totally omitted it. So she's like, oh, I didn't think it was a big deal. It's like, no, the IRS knows this already. Like when you get a W-2, that's your employer already has told the IRS exactly how much that you made. You're just getting it generally as a courtesy and to aid you in doing your tax return. They know already. So like she ended up getting audited for that. And I was just like, well, I don't know what this is. Like, and she's like, oh yeah, that's right. I got this W-2 I never gave you. I was just like, I'll do my best for you. But so yeah, all that's just a cautionary tale to say that if you get 1099, do not omit it because again, they already know. And then I have down here can be filled out online for low cost on a few websites like Tax 1099 and like. Generally, if you're that's only those are only good if you're having to do a lot of them. Later on in the presentation, I'll get into QuickBooks and just touching on it as far as like data organization. And I guarantee you, any like accounting software that you use they will automate this process for you. So you don't need to use anything external. And even if you don't have that, if you're just paying just a few people, you can just fill it out by hand and then send it out by hand as well. That's generally for people. These situations are generally for people who are sending out hundreds of them. But I just wanted to let you know that those sites are out there if you do want to just pay somebody to set it and forget it. And then I just have a little note 1099 NEC will phase out 1099 miss in most paid cases. You'll still use a 1099 miss for rents, royalties, and stuff like that. But as far as independent contractor income, it's generally going to be on a 1099 NEC from now on. Oops. Okay, so now I want to talk a little bit about grants because this is one that a lot of people want to know about because a lot of people are generally getting them in art for various reasons. So I just want to just like clarify some stuff when it comes to that. Besides revenue that you earn through trade, which is called revenue that you earn through trade is called earned income. Grants are what's called contributed income. Unfortunately, most grants are taxable. That is one of the biggest misconceptions people have when it comes to grants. Now, not to say that there aren't non-taxable grants out there, but they are a lot less common than a grant that you'll get from a leeway, a grant that you'll get from a pen, a presser, or any of these other like local funders. Like those grants are taxable. That's income. Now, last year, for COVID, some places were giving out what's called Section 139 grants. They do not go to businesses. They go to a person. So like I am Tim White. If I was to get a Section 139 grant, it will come to Tim White. It wouldn't go to Tim's Taxes or any other like LLC or any other like business entity. It's going to go directly to me. And that income is not taxable. But most grants are taxable, and generally a 139 grant, you'll know it because like they'll tell you it comes with a letter. It's like flashing lights when it comes to that. Along with 1099 income, you also include this money on the income section of the Schedule C. So you won't get it. Sometimes you won't get a 1099 for a grant, but you generally get like something at the end of the year saying that. Well, a lot of times you will too. Like so, it depends. But generally, whatever documentation that you get as far as like a grant is concerned, because you might get a grant that's under $500. So under $600. So you may not get a 1099 for it, but you still need to include that on the income section of the Schedule C. Any income you get generally, as just a rule, just as a quick side note, any business income you get, even cash, anything that you get is in the course of business needs to be reported on the income section of the Schedule C. And then I just have a small note here that scholarships aren't taxable. Sometimes you get questions about artists in residence. It depends on like the institution and where your artist in residence, and it also depends on the details of your deal. Sometimes a institution will like house a person or give you some other sort of consideration that's not cash. Those things aren't taxable. But if they give you like a stipend, that is taxable. So you have to it all really depends. Now, there is situations also where you can have non-taxable money, but they're few and far between. But as a general rule, when you're getting cash, like a cash grant for anything is generally taxable, unless in like is flashing lights. This is not taxable. So if you're thinking about it, think about it like that, as defaulting to taxable. And there may be a situation where it may not be taxable, but they're very few and far between. So again, I kind of touched on the cash thing, but for miscellaneous income. But if you did not receive a 1099 for money you received, you still should report it on this income section of your Schedule C. Again, the IRS is not getting a formal notice of the money, but they still have ways to find out. Because if you get audited and they find money is going into your account, and it was not reported on the Schedule C, you will find yourself in trouble. And I've seen it happen. I've seen people who get paid strictly through cash, no record keeping in between, get audited and have a huge headache. So don't roll the dice would be my suggestion. So again, we're still talking about business income. So I just want to take two side notes here, because not everyone does performances when it comes to getting money as an artist. Some people actually do sales. They'll sell their art, tangible art. Like tangible means like you could touch it. So like tangible sales, we have to consider cost of goods sold, or COGS for short. Some artists may be producing items for sales. So before we take expenses into account, which is coming next, we have to take out the cost of goods sold. And then I got a small example here. So a $10 shirt that costs $4 to make, the cost of goods sold is $4. So you put $4 in it to make a $10 shirt. The income for the sale is $6. So we have to take that $4 out of your income portion. So if you just sold one shirt, then in the income portion you would have 10, but then we're going to subtract the cost of goods sold 4, so it'll make your total income 6 in that regard. So, and again, I said important for any artist that sells their tangible art directly, not like a performance or anything like that. You won't include the cost of goods not sold. You'll recognize that for you making sales. So if you've made 10 shirts, so the cost of goods for that was $40, but you don't recognize cost of goods sold until you make a sale. It's not cost of goods sold. That's just your cost regardless. Anything not recognized there will be recognized later on in expenses. So you'll recognize those expenses in a different way, not the ones where that's always going to be a function of income. Basically, you'll have a bunch of static expenses, including like manufacturing, but cost of goods sold only is applied to things that you sell, not things that you're holding in inventory. And then the second side note is the return. So like cost of goods sold, if you're selling your art and you have people that return it, you'll also take that out of your income. So these are things that we're omitting from your income. So I have a small example. You sell a shirt for $10 and return it, your income is 0. So even though you got money, you gave the money back. So any money that you're giving back to people, we obviously want to omit from income. And keep in mind the amount returned is the sale price, not the cost. So even though that shirt costs $4 to make, we're talking about money that you received and then given back. So in a situation like that, the income will be 0 because you got 10 and then you gave it back, so you have 0. Pretty self-explanatory stuff, but I just like to break that down because it is a function of the income portion of the Schedule C. So now we've taken our income, now we're going to expenses. So after we have our final income total, we'll figure out how much expense we incurred to determine how much profit we did, right? Pretty self-explanatory. So when we're thinking about expenses, generally expense must be ordinary and necessary. It has to be both. Ordinary means common to the trade. Gas is the ordinary expense of a trade of driver. So I'm an accountant, so like, I don't know, like paper, I guess. I mean, I generally like to do most of my stuff online, but like paper is a necessary and ordinary expense of most office jobs. So Is ordinary, meaning like, yeah, paper, I'm going to be using paper in this trade. uh I'm not going to be using a lot of gas. So if I come and write off $10,000 worth of gas, the IRS is going to be like, what are you doing? um and then necessary means helpful to the business. So it doesn't need to be something that you need. It could be something that is could help your business grow or help your business run, but it has to be necessary. Again, going back to gas and the accountant, it's not necessary for me to have tons and tons of gas because I'm not driving anywhere. Now, if I was Tim White, the driving accountant, and I had like a desk in the back of a truck and I was driving around, which is actually sounds like a good idea. But if that was my job, then that's different. Like, but if I'm just a guy just sitting at a desk doing general accounting work, and I again come with like $10,000 worth of gas that I want to write off, the IRS is going to look sideways at that. Then I have website costs for online boutique are necessary. So online boutique needs a website. They're going to thrive with a website. So any costs related to that are necessary for an online boutique. And how does the IRS know what's necessary or not? Through NAICS codes. So the IRS determines what's necessary and ordinary through your NAICS code. What that is a 6-digit code that, and this is also comes packaged with the 1040. It's just like a big pamphlet, and you'll find what like doctor, dentist, accountant, artist, real estate agent, any whatever your profession is, it's in there. And then they use that code to determine what's necessary and ordinary for your business. So they probably have cultivated that over time. Obviously, they seeing, and it probably changes too, like as different employment landscapes change. Like a doctor who's using the most cutting edge stuff, like they might be using more, like especially now, like with like COVID, like with R&D and stuff, like people are using, like I'm sure those things evolve, and that's just one narrow example, but like they are most likely going to be updating these codes. So like depending on what's happening in your field, but that's just a little tangent. But all that's to say is that the IRS determines that through your NAICS code, and that's one of the things that you'll put in the information part of the Schedule C, which is the business income portion. So I just got a few common expenses for artists, because this is something a lot of people ask about. Trade publications, so like that's like website subscriptions, like magazine subscriptions. A lot of art, like actor people that I do their taxes for, have IMDb Pro, stuff like that. Like all that stuff is deductible as an expense. That's all germane to like being like an artist. Any publication that is like in your field, like the Journal of Accountancy, like that is like something I could buy and write off for sure. Conferences, so like if it doesn't matter where it's at, it could be in Tahiti, it can be in wherever, it could be in Mexico, whatever. If it is a conference in your field and you want to and you attend it, that is deductible, period. Workshops, pretty self-explanatory stuff. Like if you're going to an actor's workshop or like any workshop in your field, and you incur expense for doing so, you can write that off. Advertising, so advertising of all kinds. So we have print advertising, online, anything that puts your work out there in any way. If you outlay money for that, totally 100% deductible. Office supplies, that's pretty self-explanatory. Paper, ink, chairs, desks, stuff like that. Something that's more in line with artists is like headshots. Like that stuff can get written off. Like like anything like specialized too within in your realm, in like the generally like the admin portion of whatever field you're in, 100% deductible. And I kind of touched on website costs anyway, but like hosting, like if you're using like Squarespace, something like that, like building your website, like anything related to the site is 100% deductible. Union dues. So like this again, when it comes to like actors, they are generally use like this is a big one for them. So like they can write all that off. Anything that you pay for your like union dues, 100% off. And agent expenses. Some people have an agent to help get them work and stuff like that. Totally can write all their expenses off. Anything that's attributed to you, even ones that are like automatically taken out of your pay. I've seen actors get checks and their agent expenses are taken directly out of the check. So they'll get a check and then they'll deposit the check and then they'll totally forget about the they'll totally forget about that portion of that, which is a big deal because it's just like any other deduction. Like that's a payment that you made to your agent. You just did it through a check. So even though you got the net amount, we still need to back up into finding how much you paid them and then put it on there. It's something easy to forget when it's being deducted out of your check, as opposed to like getting your full check and then writing a check out for somebody else. So like try to keep that in mind when if you have anything as far as like that's coming directly automatically out of your pay instead of you like making a payment for it. And then I have taxes, self-employment and payroll taxes. So if you have staff, you'll be paying like regular taxes for them. Like you'll be paying employment taxes for them, like FICA and stuff like that. That is deductible. And then anything that you pay in self-employment taxes, so we beat that into the ground already, but whatever you're paying in self-employment taxes that you'll be reporting on Schedule 2, that is deductible. So like if you paid that last year, this year, that was a tax expense that you paid, so you get to write that back off. And of course, tax prep. If you pay somebody to deal with all this instead of dealing with it yourself, then whatever you pay that person is also a deduction. So I have this and it says there's common expenses that need additional explanation. So phone is a deduction. However, only business part is deductible. So if you have one phone, then you generally, if you have one phone, then you generally are using it for pleasure or personal and business. What we want to do is we want to find a ratio that we can apply to your total overall cost. So if you're using, let's say it's half and half and your bill for the year is 1,000, you can write 500 of it off. But the trick is finding that ratio. Sometimes it'd be like, I never talk on the phone, like, but you can be using the internet on your phone to be doing business stuff or personal stuff too. So like you want to try to get a fair percentage if you can, and then we'll apply that percentage to the total yearly amount, and then that's what you'll write off. And then I also have rent here. Like the phone, this is based on a percentage of business use. This differs from the home office deduction that we'll discuss later, because in COVID, a lot of us have been working from home, and you can deduct some of your general home expenses off as a deduction, as a reduction of income on the Schedule C. It's a special Schedule C only deduction. This is for offices and spaces outside your home. So rent is not the same thing as like your rent that you pay. Rent is for stuff that you do outside your home. So like a shed or or actual office, like that rent is something that you will write off, not the rent that you would be doing from like your home. So like if you have an office somewhere, you can write that off. Or if you have like, let's like another example with your next, like they have like props and stuff that they have in storage. So if it's just their stuff in there, then you can write 100% of that off. But the minute you put like a couch or something in there that like came from your house, then that is skewing. It's not 100% anymore. It's going to be whatever square footage that is minus the total amount, and then we'll derive a percentage from there. So it's generally the IRS ain't going to get into that sort of minutia, but if you're trying to do it straight up, that's what you would that's how you would calculate that. And then I have business meals. Basically, anytime you meet with someone to discuss or do business, you can write off 100% of that meal. It used to be 50, but for the next few years, based on the CARES Act, to get people back into restaurants after COVID, they're allowing all business meals to be deducted. So this is huge. Basically, you used to be only to write half of a business meal, and then you write the whole thing off. So have as many business meals as possible in the next few years because they're basically going to be all, you can write them all off. So I have common expenses for artists' home deduction. So let's get into this home deduction thing. So you can deduct part of your mortgage or rent based on how much of your home you use exclusively for business. Then I have a little example here. A 1,200 square foot house use 300 exclusively for business. So it doesn't have any other thing. It doesn't have like a TV or anything. It's just for business only. So you will be able to write off 25% with that because that's 300 divided by 1,200 of your mortgage or rent. And that's not just mortgage or rent. You also can write off utilities like water, gas, electric using the same ratios. That's pretty huge for people. So if you're using 25% of your home for your business, basically 25% of your living expenses you can write off. So, and that could grow depending on how much of your house you're using for it. And generally, like the higher that ratio goes, the more you are tempting the fates. But it is fair. I mean, if you are using half of your home to do something, and you can truly like support it, then you can write off half of basically all your living expenses. That's pretty nice. So as the common expenses, travel. Anytime you need to be away from your home for business, you can deduct expenses related to that, period. So that's hotels, plane, trains, rental car, so any sort of transportation, and meals. So these sort of meals, these travel meals are not lumped into the same sort of business meals. These meals are 100% off. So, but now everything is 100% off, so it doesn't really matter. This doesn't include money you were reimbursed, to deduct that expense by the amount you were reimbursed. So like sometimes a third party will send you to on a business trip, and they will partially give you money towards that. You can get that back up to the amount that they already have. If they're giving you money back for the amount that you've already spent, then you can't like double dip basically. It's just up to the amount that you're being reimbursed to basically. And then here's another big one, vehicle use. Generally, IRS allows you to write off expenses related to the business use of your vehicle. And in 2021, it's going to be 58.5 cents per mile. So generally, if you drove 1,000 miles, then you would be looking at $585 as your deduction that you can go against the income portion of your business income. That's the standard deduction, and you can also do the actual one. So like in that example, I drove 1,000 miles, I got $585. If you drove that same 1,000 miles, but then your gas, tolls, parking, maintenance, depreciation of your car eclipse that amount, then you want to use the actual method, because then you'll be getting more bang for your buck there. So this slide is generally for like gray areas that I've come across in my time so far. Generally, people will talk about clothing. So like, hey, like I need to look nice for this role or something. Can I write this off? And I got down there. This is a landmine for the IRS. If you're claiming this expense, you have to be ready to defend it as necessary. Typically, nothing you wear normally is deductible. So it's like this 3-piece suit that I have a client that's a DJ, and he always is asking me about, can he write off his like fancy clothes? And the answer is no, because you can't write off regular clothing. Costumes, specialty gear, uniforms, that sort of stuff you can generally write off for clothing. But just a nice suit, something that you can use outside of business, is generally not deductible. Makeup and hair. Basically, only actors that must achieve a certain look for a role can deduct the cost of hair and makeup. That's not limited to artists. I mean, actors. That's also anyone that has to perform and look a certain way. To further clarify, the cost to create a certain look, actors, models, or any other place, can be deducted. So if they was like to we need you to cut the sides of your hair off so you can have a mohawk for this role. The cost of doing that is deductible. But then after the roll, if I'm like, oh, this looks good on me, and I keep doing it, those costs are not deductible, basically. So getting to getting there is deductible, and keeping it up during the run, or however time that your employer needs it, or whoever commissioning you to do it, however long they need it. But then once that's over, that's not deductible anymore. And then also gym costs is another one that I get a lot of. They say, oh, I need to be fit, to look good on stage or screen. So generally is if you're doing something that requires your fitness. So like a dancer needs to stay fit to dance, whereas an actor doesn't really need to stay fit to act. You can do it without looking a certain way, whereas a dancer definitely needs to be physically fit to dance, basically. And that's not just dancers, that's other like circus performers and stuff like that. Like they need to have their bodies in a certain way, whereas actor, that's too broad for the IRS to be like, you can write off your gym costs. So keep that in mind when trying to deduct things. I got the side note for depreciation for stuff. So like this is more for like people who sell things, but you can buy equipment and other fixed assets for your business and expense them gradually on depending on what kind of asset it is. That's just depreciation in general. So I just got that on here. So I say you buy a new computer for your business, $1,000. You can claim $200 each year as the depreciation expense over 5 years, assuming 5 years is useful life of the computer. So I just basically have that here to just explain what depreciation is, because a lot of people will be like, I got this laptop for business, and that's all good. Like a laptop generally has a useful life of 3 to 5 years, so like we can depreciate it all over time. So each year you have a little bit of expense to go against your income. Or nowadays we can just like right now we're in a period just kind of like the 100% of business meals can be written off, whereas these things in the CARES Act where like you can just straight up to $20,000 in equipment, you can write that off all in the year that you bought it. You used to have to depreciate it, but now we're in like this depreciation holiday, so to speak, where you can just up to 20,000, you can just write it straight off. So again, depending on your tax strategy, that can be a boon for you. So that's a lot of info. How to keep all this tracking together. So you're tracking expenses, you're tracking income, you're tracking a bunch of different things with this going into your tax situation. How, as a business, do you track this stuff? I have on here Google Sheets and Excel is good. A lot of people, when they send me stuff at the end of the year for their income and their expenses, they generally send it to me in an Excel sheet. Like totally fine. As you grow, however, that may become cumbersome, but starting off, absolutely fine. QuickBooks or other online programs are better. It's better to track yourself because you can generate financials quicker doing it out of like QuickBooks. So if you don't have to compile things with QuickBooks or any other online bookkeeping program. A combination of two is even better than that. So like you have schedules that you have in Excel, and then you have your core program of like QuickBooks or something like that. That absolutely works best. And then I have size and nature of the business also forms the best approach. If you're just an actor who just wants to have something to like track your expenses, then Excel is going to be, or Google Sheets are going to be more than enough. But if you're somebody who's really trying to grow your business, or maybe even like got to track sales, got to track inventory, stuff like that, then you're going to want to definitely look into like a bookkeeping program for sure. So what's new this year? We talked about the child tax credit. We talked about how there is a refundable portion and then a non-refundable portion. We're going to look at it overall here. But in 2021, Congress started sending families checks starting in July. So the first checks went on July this year. Those checks were in advance on the child tax credit, explained earlier. Of course, we'll lessen the amount we'll claim on a tax return by the amount sent out. The IRS sends a letter out to let you know how much was advanced. So we just got our letter like maybe like 2 or 3 days ago. Basically, what that says is when we went to like start our non-refundable deductions, we generally would have put in 3,600 per kid or 3,000 per kid if he or she is over they are over 7 and above. 7 and above, I believe, is 3,000, and then and below that is 3,600 per year. But we're not going to do that because in some cases they have sent some of that money to you already, and they are sending you a letter to be like, Tim, we've sent you $750 so far, so don't go ahead and put $3,600 on there. Go ahead and short that by $750 because we've already sent you that money. So I would put whatever 3,500 is. I mean 3,600 minus 750, which is 3,850. I would be putting that on there. I mean 2,850. I'll be putting that on the there instead of 3,600 because they've already fronted me a portion of that already. So I hope that kind of clears that up. We could talk more about that because that's like the main big thing this year is those checks that went out, because that's going to be a headache for everybody. I believe people not having because it was a headache for like the COVID payments last year, which was a new thing that we went over. And then I'll talk about that now, the recovery rebate. So last year, people got checks from the government for COVID, and you should have gotten 2 in 2020 and then 1 in 2021, I believe. I don't know. I think you should have got them all in 2020. Nevertheless, people were getting them late, so it doesn't matter if you did receive one. You should be getting a transcript for that, just like the child tax stuff. So if you should be getting both letters basically around the same time. But if you didn't receive it ever for whatever reason, the IRS had bad bank information, they had bad address information, and you never received it, and you were entitled to it, you can put that on your tax return as a refundable credit. I seen a lot of people do that last year. It took a long time for those returns to process because they have to do so much checking. They have to see if they sent something out. So the IRS had to do a lot more bookkeeping in that regard. But this year they're going to be sending out letters that say, "Hey, we sent this amount. Give this to your tax people," and then you'll shorten that from what you would be claiming for the recovery rebate. It should be 0 for most people. Most people should have either gotten a check or already claimed the money for that. But for whatever reason that you didn't, you still could put that on your 2021 taxes if you fall into that category. And we could talk more about that too. So, and then I also have charitable donations. I explained that donations could be included if you are itemizing your deductions. And I should say new to 2021. Excuse me, I got my years mixed up. But new to 2021, you can deduct up to 300 as a regular deduction without itemizing. So that person who ties a lot generally, or just gives money to like various causes, but does not itemize their stuff, because if they itemize, it'd be less than the standard deduction. And we went over that extensively. This is just allowing you to get $300 as a deduction off of it without itemizing. Of course, if you itemize, you can get more if you are like doing a lot of donating and doing a lot of paying local state taxes and have a lot of medical deductions and stuff like that. That's not going to affect that. But if you're not doing all those things, you can do up to $300 as just a regular deduction. So if we do income minus deductions, that $300, we can put that in deductions to bring your income down a bit. So that was it. I will stop the share. I do want to just put my email out there, and I'm sure that this will go out as well, because I'm going to put this in the I can put this in the whole like PowerPoint in the chat, but you can always email me at timwhite02@gmail.com. No question is too big or small. And if all this still went over your head, if I did not do a good job of breaking this down correctly, you can always feel free. If you want to have somebody take care of your taxes, I'm more than happy to do so. If you could say that you saw my seminar and like I can give you a discount off of how much I generally charge. Or if you want to take a stab at it yourself, again, no questions too big or small. I'm more than happy to answer any questions as far as that's concerned that you may not think of now. If you think of it later or anytime, you could timwhite02@gmail.com is generally where, and I'm generally pretty quick as far as like turnarounds concerned. So I will stop sharing now so I can see everyone. And yeah, if you have any questions, feel free. So I was not looking at the comments here, so I don't see any in the comments, but yeah, if anyone has any other questions, I'm definitely free to do so. Andrea?
Yes,
Okay.
hi. Tim, can
Hi.
you hear me?
Yes.
Okay, hi. Thank you so much for this. I appreciate your wisdom and guidance. I just have a question. I have a couple questions.
Sure.
I have a question about the grants that when they are project-based and it's not, it's like, I understand that it's considered income taxable, but when the grant has been given so that you can produce something, and you use all of the money to buy the materials, the materials then become itemized deductions.
Yeah, well, in your case, the materials are expenses. So let's say a funder gives you $10,000 to do something, and the materials are $10,000. So what you will be reporting on your Schedule C is income of $10,000 and expenses of $10,000.
Got it.
So it would be a wash in that case.
And so my other question is, as a multidisciplinary artist, and I just formed the LLC last, 2021. So this will be my first time filing taxes under my artistic business. But I'm a multimedia, multi-platform kind of artist. So for the NAICS code.
Yeah, I get this question a lot. So yeah, you'll be doing multiple Schedule Cs. You'll want to separate each business into its own entity, and then you'll be doing multiple ones. So like, let's say let's say you were acting, singing, and dancing. There's 3 separate Schedule Cs, and they all would flow into the body of the 1040. So you'll end up with one income number. So one part could have took a loss and doesn't have any self-employment tax, and then the second one could have made a lot of money and generated a good amount of self-employment tax, and then the third one, maybe that was close to a wash. Whatever the net is going to go into, the net means like the equals, like that's going to go into like your income, and then whatever net self-employment taxes you'll have, that will go into Schedule 2, which is the other taxes. And self-employment tax also has its own form as well. So like it all follows along, but that's just another bit of minutia. But yeah, the answer to your question is generally you're going to separate them and you're going to treat each one as its own entity, and then the nets are going to go into the main form.
Got you. And then my final question is, I put on some programs at the end of the year where I paid artists as part of a symposium. All of it was like $500. So can I, if I don't generate 1099s because it's under 600, does that mean I can't qualify them as expenses?
No, they're still expenses to you. So like whatever you paid, you just don't have to report them to the IRS. Well, you don't have to send out a 1099. You still have to report it to the IRS on your tax return. You just are not obligated to send out a 1099 in that regard. See, because the 1099 generally tells the IRS that they were paid over 600, and it tells the recipient and the state also that they were paid 600. That doesn't mean that it didn't happen, and it doesn't mean that it's not an expense for you. Those things are still true. You just don't have to send this additional form out. You still have to report all the income, and then that's all an expense for you. So, like anybody you pay $500, it's a $500 expense that you incurred.
Okay, and so if I were to decide to check in with each of the artists that I paid to see what their preference is, whether they get a 1099 or not.
Oh
like,
yeah, yeah, that's a great question. You could give 1099s to everybody. You're not obligated to it up to 600. You could give them all 1099s, even if they didn't hit that $600 threshold. That's a very good, very good point. And I'm gonna edit the PowerPoint to include that because that is a great caveat. You could do that. It makes it easier for everybody, and it makes sure that everything is lined up. The IRS is going to be a lot. It's going to be a lot easier for you because they won't. That's just one less expense that they have to question, and the people that you're paying now, they have something tangible in their hand to remind them how much they were paid. Because I see that a lot too. Well, I got paid something. I don't remember how much. If you're doing that over the span of like 10 or 12 engagements over a year, then that can add up pretty quickly if you're like forgetting all those amounts because you got paid under the threshold, or you got paid over the threshold, and then but the business never just didn't send the 1099 out for whatever reason.
Thank you. So with the 1099, you said you could really just create them even by hand. Does that mean
Yeah.
I don't need to get a W-9 from people in order to issue a 1099?
You still do need to get a W-9 to issue a
Okay.
1099, but all that is just all W-9 is just a verification of Social Security number. If they're generally giving you a Social Security number, you didn't do a W-9, it's not the end of the world. You still can send out 1099 without it, but you generally want to do that. Because you can put in any information that you want. You're still sending it to the IRS. All you're doing then is just confusing the IRS if you don't have someone's real Social Security number, which is the real thing about a W-9, making sure that you have correct info, especially when you're paying a business. Because a business, you're generally not going to go off their Social Security number. Sometimes you'll have to go off their EIN number, which is also a 9-digit number. So all the W-9 does is just confirm whatever number you have.
And the deadline to do that is January 31st?
Yes.
Okay. Thank you so much. I appreciate.
You're welcome. And then again, if you have any other questions, please feel free to reach out to me.
Sorry. So this is my first year, like I said, with the LLC designation. So I still just submit one because I'm a sole member.
Proprietor. Yeah, so that's another thing that trips people up. LLC is just a legal designation. You're still generally going to file your taxes just like you normally would under a sole proprietorship. The only difference between the two is just that the legal protections you get as an LLC. As far as reporting is concerned, you're generally going to do everything the same way on the federal level and it's on the state level. There's no changes to like your rates or your reporting status or anything like that. Nothing changes. The only thing that changes is just that how successful is a lawsuit going to be against you. That's the only thing really that changes with LLC.
Thank you so much.
You're welcome. I'm guessing no other questions. Okay. Well, yeah, even if you don't remember any questions, again, timwhite02@gmail.com. I'm more than happy to answer any question at any time. I'm doing this all the time generally. And during the tax season, I'm like my most busiest. And this is like really fresh in my brain now. So but yeah, all to say is like I'm wholly available for any tax questions. I love doing this and I've been doing it for a long time. And So yeah, hit me up.
All right. Thank you. Thank you, Andrea, for your questions. It's so great to see you. Hello, fellow everyday artists. We just did a residency together, so it was nice to see Andrea.
Hey,
Yes.
sorry I had to keep my camera off. I'm recovering from this dreaded COVID, so just
No. Sorry to
yeah,
hear that.
it got me.
Sorry to
So,
hear that. You
so
are
y'all
not.
be safe.
You as well. I just got out the woods with that. So speedy recovery. I'm wishing you one.
Thank you so much. I appreciate y'all both.
Yeah, absolutely. Yeah, please get better. I mean, it's terrible, man.
Yeah.
So I'll see you next time.
Yes. Thank you for joining us, Andrea. Have a good one.
All right.
All right.